Hi, I'm Aarati Krishnan. Welcome to the latest episode of Question of Money. This time we'll talk about what kind of insurance do you need. Sometimes carefully made investment plans can get wiped out by a single stroke of fate. A sudden illness may rob a family of its earning member. A freak accident may confine an earning person to a wheelchair for a while. When such acts of God hit you or your family, yes, your emergency fund can come in handy. But rather than having your emergency fund fully cleaned out by a catastrophe, it is cheaper to buy insurance. Insurance is a game of probabilities. Say you wanted to save up rupees 1 crore so that your family will have some fund in case something happens to you. Suppose you were to create this 1 crore out of your own savings and investments, you would have to invest nearly 80,500 rupees for 30 years at an 8% return to get to that number. But a 25-year-old can simply pay 15,000 rupees a year as premium and buy a rupees 1 crore insurance cover that will cover him or her till the age of 75. And the protection starts right from the time you pay your first premium. How do insurers manage to pay such big claims out of such small premium contributions? Well, they play on a game of probabilities. Now, insurers know from past data that the mortality rate for 25-year-olds in India is 0.093%. This means that if they collect premiums of 15,000 rupees from say 1,000 25-year-olds, only 9 are likely to make a life claim in any particular year. They can pocket all the premiums from the remaining people who have paid them. This game of probabilities works well for you too because you get a 1 crore life cover for a very small investment. Therefore, they get to pocket the premiums from the 9,991 other people who have paid them the premiums. Insurance is one of the most oversold products in India. So, right from the time you start working, you will find that you are pitched insurance products by your friends, neighbours, acquaintances, colleagues, many of whom are insurance agents. There are insurance products available today for everything from weddings to train trips. Committing to too many insurance products just at the beginning of their career will mean you will end up paying fat premiums every year out of your salary, robbing you of the ability to save or invest in other assets which can give you much better returns. So if you are a young person who's just started out on their career, what are the two types of insurance you need? A health insurance policy covers your expenses towards hospitalization in case you have to undergo a surgery or have other illness that requires you to get yourself admitted. A health insurance policy can be a standalone policy which covers only you, or it can be a floater policy that covers your family, your partner, or other dependents. The other kind of policy that you may need is a pure term cover. Pure term policies pay the nominees a big lump sum in case the breadwinner of a family or the earning member of a family dies. You need a term life policy if your parents, your spouse or other members of your family depend on you even partly for their living expenses. You also need a term life cover if you have large loan obligations and you wouldn't like to burden others with it in your absence. You may not need a life insurance policy if you don't have dependents or loan obligations and you don't want to leave a legacy for anyone. Remember that a life insurance policy only pays money to your dependents in case you die. You don't get to enjoy its benefits. It has become fashionable for agents to sell young folks life insurance policies of multi-crore of rupees and health insurance policies of 1 crore, painting all kinds of scary scenarios. But the truth is that if you're a young person in your 20s or 30s, a rupees 10 lakh health insurance policy is more than enough. This will sufficiently cover the kind of illnesses or surgeries that you can experience when you're that young. Health complications that result in prolonged hospitalization or complex surgeries like organ transplants are the ones that can set you back by 1 crore rupees or more, and these are a very rare occurrence in any individual's life. You should also note that cashless insurance policies often do not pay your entire hospital bill even if you get admitted, and a part of the expenses for hospitalization will have to come out of your pocket. The earlier generation, like your parents, loved to invest in insurance policies that combined investment and insurance. But these are very poor choices because they neither give you adequate life cover nor do they give you good returns. Fixed return products like traditional plans or endowment plans only give you a return of 4 to 6% a year, and there are many investment avenues that can help you do much better. There is a category of market linked insurance products called ULIPs that invest your money in stocks and bonds and can give you a better return, but they have a 5-year lock-in period and they are less transparent than mutual funds. Therefore, if you are being aggressively pitched insurance products, stay off all other products and stick only to pure term covers or health insurance covers. So in the next couple of videos, we will be talking about pension products and retirement products, starting with the Employees Provident Fund, the EPF.